Valor, and for some of you, you guys know, but our goal is ultimately one thing, right? It's to make accessing tax and estate planning, trust, and tools simple, easy, and seamless, right? So, for every day you work with clients, you help fill their needs, whether it be investment advice, whether it be helping to deal with insurance, life planning, all the great things that go into it. We want to be one leg of your stool, right? We want to make sure that we're offering, various tax and estate planning trusts and things that you can help your clients with, making it seamless, making it simple, and ultimately making the customer experience as easy as possible. So that's really our main goal. We'll talk a little bit more about us throughout sort of this presentation, and we'll share more about how we can help you. But this presentation is meant to be really about one major thing, right? Charitable remainder trusts, how can they create value for clients, and how can they create value for you? So, we're going to cover those. I'm going to share my screen. We've got a little presentation just to help sort of guide the conversation. Let me know if anyone can't see my screen, but I'm going to go ahead and start rolling through this. So a couple of things we're going to cover today. Very simple. Corrupt basics. Some of you know about charitable remainder trusts. I'm sure some of you worked with them, used them, talked about them with us. Regardless of what it is, you probably know something. We're going to go through some of the simple headlines just so we can make sure we're covering the essentials. And we can always dive into some more specific dynamics later, but I want to just make sure that everyone understands the basics before we dive into what does it actually mean for clients and advisors, and ultimately how we can help, right? So for all, charitable remainder trusts are ultimately a very useful tool for deferring capital gains tax. Plain and simple, they're a great tool for any appreciated asset that your client is considering selling. They can ultimately help save them taxes on the initial sale, as well as, let me not touch that, taxes on the initial sale, as well as create additional wealth sort of over time. Really, the right way to think about these trusts is more of a superpowered IRA. Sure, everyone here has worked with clients that have IRAs and know how they work, but just as a reminder, right, IRAs, you can contribute up to $7,000 per year, and you start taking distributions potentially when you're 59 and a half, right? So limited contribution, limited liquidity, or no liquidity really until you're 59 and a half, unless you have penalties, right? Charitable remainder trusts functionally work similar ways, except for one, they have no contribution cap, right? You could put $1 billion in a charitable remainder trust and it doesn't matter, right? There's no limit on how much you put in, and you don't have to wait till your retirement age to take distributions. You get liquidity from the trust almost immediately the first year you set it up. So, IRAs are trusts in themselves. Charitable remainder trusts are a superpowered IRA. So the main benefits, right, of a charitable remainder trust are simple. No taxes upon sale. You have a client that's selling an asset, regardless of the level of appreciation, the trust is tax exempt. They pay no taxes upon liquidity. So that's step one. Two, a smaller benefit, but still important, is they get to take an upfront tax deduction, right? Say you have a client that puts in $1 million into a trust, or a charitable remainder trust, they get a $100,000 charitable deduction upfront. They get to use it that year on the taxes, depending on where they live. That's immediate value that the trust brings them. And it's just another side benefit for setting it up. And then the last piece is really the tax-free growth, right? These trusts, again, right, they're tax exempt. All assets inside the trust can continue to grow tax-free until you take distributions. Obviously, we call these tax-deferred trusts for reasons. Eventually, an individual will pay taxes, but it's once they have liquidity from the trust. Going a little bit further, just to make sure we're covering all aspects of it, we want to make sure we're covering the good things and the bad things that come along with charitable remainder trust. You guys are advisors. We act as advisors in certain respect. We want to make sure everyone understands the pros and the cons, and we don't just sell the good. But ultimately, and I think you'll see that after this, if you don't already know, the pros outweigh the cons, right? So first, we've already talked about it. Tax exempt trust. So, initial liquidity event, no taxes up front. This is a no-brainer. More capital generally equals more returns, right? You as advisors know putting more money to work in the market means more returns over the long run. So having those tax dollars that you would have paid out initially to reinvest and compound can ultimately be huge, right? They can really lead to some real value. And we have a real example we're going to show here in a few slides where we show you the exact numbers. How much more money could a client make? How much more money can you make, right? So more capital, more returns. The trust does offer access to liquidity, right? Unlike a traditional IRA, you can take money out of the trust every year. The percentage is determined around based on a lot of things: how long you set the trust up for, how old you are, a lot of things that go into it. But ultimately, there is liquidity, and it does mean access to funds for whatever reason. Some people call this a pro, some people call it a con, just depends on who you are. Charitable giving. There is some charitable intent when you're setting up a charitable remainder trust. Surprise, surprise, you will leave some money for the charity of your choice at the end. The benefit of this, it can be the charity you choose. It can be a donor advised fund that your client already has set up. It could be their own family private foundation. It can be pretty much anything under the sun as long as it qualifies as a charity. And that's one of the major benefits of these trusts. The last two pieces, asset protection. You're saving and protecting your assets from essentially creditors and outside parties. These are asset protected trusts, so they can't pierce the veil. It's another layer of defense when setting up the trust itself, and just another side benefit. The last piece, and this goes hand in hand with the tax exemption, is the tax smoothing piece. Obviously, selling your asset without paying the taxes up front is the biggest benefit. But as you all know, when you have a large liquidity event, your client's tax rates spike, right? Progressive tax. When you take distributions from the trust at a smaller clip over time, you're reducing your overall effective tax rate. So in addition to the tax exempt sale up front, you get some tax smoothing over time. So those are really the major pros. As it relates to cons, right? Because we want to make sure we're covering both sides of the equation here. These are irrevocable trusts. When you set them up, you're sort of committing to a strategy. You're in it for the long haul. Now, there are ways to get out of it if you have to, but in general, it's never good to go into these sort of with the idea that you might try to find a way to back out of it if you have to. You can't take leverage on assets within the trust. This goes hand in hand with the asset protection piece. You're protected, your assets are protected. It means that banks won't loan against assets inside the trust, and the government enforces regulations that says you can't, right? So ultimately, can't take loans against the assets you placed in it. There are some minor investment limitations of things you can do within the trust. And when I say minor, it's as simple as you can't invest in your own business, and you can't trade on margin, and you can't buy your own house. Other than that, the things that you're putting your clients into every day, and maybe even alternative assets that you don't, things like crypto, things like private equity, all those items are perfectly fine to go within the trust. And so in a lot of ways, we like clients and advisors to think about these as just another account that you manage and another account that they can invest out of. So two cons that go hand in hand, but are cons that we control. They do require some administration, and there are some tax filings. But guess what? If you work with us, there's no headache. There's nothing to do. There's zero time that you have to worry about each year beyond, hey, where should we send your tax return? And what questions do you have? So all in all, we take two of those cons and we try to reduce them next to nothing. The last piece is, and this goes to the liquidity dynamic, is you don't have access to all the money at once. The way that we've historically worked with clients and advisors is whenever they come to us with a scenario, say they want to put $1 million in the trust, we always upfront, hey, you can't pull all this money out day one. So if you have needs, right, financial planning goals, whether that be you need $200,000 for a home renovation, you want to pull money out for your kids' college, do that ahead of your liquidity event and do that ahead of putting money in the trust, because you can't just pull it out once you've decided to do it. So again, cons that can be controlled, but ultimately are things that we want people to understand as they go in sort of eyes wide open. So what does this mean for clients, right? We've talked about trusts, we've talked about charitable remainder trusts in general, what the pros, what the cons are, but where does the rubber really meet the road here? So let's just go through a really simple high-level example, and then we'll show the value. So up front, right, assume you have a client, they live in California, they're in mid-30s, they work for a startup. They're going to have a major liquidity event, right? They think they're going to sell $2 million of their stock this year. They started there early, so they got it at, they basically invested nothing, right? So it's all effectively gains. In this scenario, right, like we're just assuming 35% overall long-term cap gains, plus minus some. If you sold that stock without doing any tax planning, right, they keep 1.3 million. We all know that math. That's quick and simple. With the trust, they keep the full 2 million, right? That's $700,000 more that they get to keep day one and invest over their life, depending on how long they set the trust up for. So that's 53% more dollars to invest than if you had if you'd done no tax planning up front. So first and foremost, right, the headline here, hey, you pay no taxes. You've got more money to invest. We've got more assets for you. All things are great. So what does that mean for value, right? How much more actual money can a client make? So assuming the same example, right? $2 million liquidity event. If they pay taxes, they invested 1.3. If they didn't and they used the trust, they invested 2 million over their life, assuming a 50-year sort of charitable remainder trust, which is average life expectancy for 35, 36-year-old. They would expect to make, or could expect to make, an additional $2.6 million just by setting up the charitable remainder trust up front. Now, there's obviously a lot of assumptions baked into here: growth rates, how much distributions are they taking out annually, all the various aspects that go into it that can drive these numbers. So obviously the additional returns can vary, but the high level here is, in general, they should expect to make more money over their life. Same investment strategy as if they'd done the trust and as if they didn't done the trust, if they had not done the trust. Now, in addition to this 2.6 million that they could expect to make over their life, the charitable organization that they chose will also get $675,000. So you're already starting to see sort of the win-win scenario of charitable remainder trusts, or CRTs. Let's just call them CRTs and make it easy so we can shorten that out to say it a million times. The client wins and the charity wins. The charity always wins because, at the end of the day, they get money regardless, but the client wins and the charity wins. So this is really huge, right? So not only have we covered sort of the main benefit, right? The tax exempt sale, the tax smoothing, the upfront deductions, but really the long-term value, right? Like, at the end of the day, we're all ROI focused. You as an advisor advise your clients on investments they should make based on risk, based on reward. This is no different, right? You're helping your client save money on taxes, as well as thinking about the long-term ROI. And that's where our mind is, right? So it's a really big benefit to clients. This just outlines, again, sort of that same example, but sort of add some additional numbers to it to make sure that that's clear, right? So this $2 million exit, that's 86% more in returns over their life. They'd have made 2.9 million without the trust, assuming the same growth rates, assuming the same distributions, all because they started with $700,000 less to invest day one. So a little bit of planning up front, a little bit of additional work, seamless, all to create, sort of immense value. And don't forget, they still get a $200,000 deduction the day that they put their assets in. So all great things. Moving on. So quickly, what is the impact for advisors, right? At the end of the day, CRTs can be a very useful tool, and they can be very helpful for basically selling any appreciated asset. We use startup equity as the example, but think about your clients that own homes, right? Think about your clients that own rental properties. Think about your client that owns a rare car collection, right? We've seen every random scenario under the sun of an appreciated asset that could go into a charitable remainder trust. And so, at the end of the day, any of your clients in their walk of life will likely have some asset, even if it's stock that you've put them in, right? It can be the Apple stock that they asked to buy 5 years ago. There may be a scenario that the charitable remainder trust works well for them there. So that's the impact for clients, right? Long-term ROI, asset protection, upfront charitable deduction. But what does that mean for you as the advisors, right? Let's be real. In this world, we're all naturally greedy in some way or another. And so we should all be looking out for how do we do well and how do we make clients do well, right? So first and foremost, when you think about the impact for advisors, a couple of the things that we like to highlight first and foremost is we've observed this, and I'm sure you have as well. Clients expect more from advisors every year, right? Each year they expect you to do more things, or they have more desires and things that they wish you could do. By helping them with charitable remainder trusts and helping them with tax or estate planning trusts broadly, you give them not only sort of the beautiful upfront elimination of their taxes, you help them save money, which is a good headline for everybody, but you're giving them more services, right? You may not be providing every step of that and doing every single aspect, but the way that we work with our advisors and their clients, we make it seem that way, right? We're a function of you. We're here to help you as the advisor. We do this for you and for your clients, and we make it really seem like we're a part of this. We're not obviously positioning ourselves as your company, but we make it seem like we're all working under the same goal. So that's one of the big areas of focus that we've seen on the advisor world over the past, few years. And this just adds to that, right? I'm sure you've observed it as well. If you haven't, I'd be curious to hear. But that's one major area of value that you as the advisor. Now with that, right, additional services for clients generally means probably better retention, more fees, right? more ways to help, more ways to keep them happy means less turnover. So all in all, these are beautiful things for you. Now, that's outside of the services we do. Just by being here and offering it, it helps you. But in general, right, like it's one of the big value pieces that we've identified when it comes to working for advisors. Now, what does the math mean, and how does the math actually look for you?
And just before we get into the numbers, does just wanted to just like take a kind of quick pause if anyone has any questions on, I know at a high level, right, paying less taxes, keeping more assets for your clients, yourself makes sense, but curious if anyone has any questions, kind of things that they want us to go deeper on or would be helpful before we go too deep into the numbers here.
Yeah, I would just say I'm looking forward to hearing how exactly you guys can help and what the ideal prospects for us to bring to the table are. Joe mentioned a little bit, but you know, and any other sales ideas you might have to help us with prospecting as well.
Yeah, that's a good question. Happy to talk about that even ahead of sort of going into the numbers. Really, for you at the end of the day, right? You know, when you think about the clients that you interact with, the largest single denominator is thinking about what appreciated assets do they have, right? Whether it be their stock, whether it be their home, whether it be their private business. You know, ultimately, you're just trying to identify where the opportunities exist. Now, again, I sort of always coalesce around this appreciated assets piece, because if someone owns a business that they just bought for $1 million and it's worth $1 million, it's not a good fit for a charitable remainder trust. I can tell you today, because there's no appreciation, there's no taxes. What's the point, right? But for those folks that haven't made investments over the years and people that you've made investments for, there's value there. So two real ways, right, you identify those people. One, through your everyday conversations with new clients, right? New clients, you're sort of getting a feel for what they need and what they could look for. And if they're thinking of selling something, that's an immediate value point that you can latch onto. Otherwise, right, you know, you're thinking about how can I invest your dollars afterwards? Instead, hey, let us help you save money on your taxes up front. And we're here to make sure that when you make the right investment decisions post the fact. So that's sort of step number one. Number two is if you already have clients, right, and you understand what assets they have, you have a pretty good idea likely of where their pain points might be, right? They have a concentrated equity position. They need to diversify their portfolio. They've been thinking about it, but they've been hesitant because they're afraid they're going to pay taxes. Well, guess what? You now have a solution. That equity position you got them in a few years ago that's increased and is now 40, 50% of the portfolio, you now can sell, manage the money still, right? As if it were in just, you know, a normal taxable account, and then reinvest those proceeds without that upfront tax hit. So those are sort of really the major ways that we've seen advisors identify and sort of find those client scenarios. Now, obviously, the way that you pitch it is going to come down ultimately to your style and to what you think best. But the biggest thing that we always talk to people about is think of the long-term value, right? No one likes paying taxes. If anyone says you like paying taxes, then, you know, they're unique. So first and foremost, no one wants to pay taxes. And so if you can hit them with the quick, hey, guess what? We can get you tax-free. That's a big win, or tax deferred, at least, if you want to be very specific. But then the long-term value, right? Reinvesting those same dollars and having that long-term ROI, that's really the big pitch, right? Everything else is sort of window dressing, right? And it helps it, but the headline number is big money. I don't know if you have anything else you want to add.
No, I think you nailed it. I mean, it's just a thing of if they have a big taxable, like capital gain event coming up, the bigger the taxable event they have coming up, the more valuable the structure is. That in combination with the higher their tax rate, the more valuable this is. And that's kind of, and I think the other thing to Joe just add on there is it's also, if they, to your point earlier, if they don't need the money, if they're going to sell, you know, their appreciated house or business, but then plan to spend all the money right away, this may not make sense. But if they have that appreciated exit and they don't need the money, all the money right away, plan to invest some of it for their future, that's where then this strategy and structure can be really powerful.
Yeah, absolutely. And just to add one more thing to that, this is something we talk to every single customer. We always do. Obviously, as the advisor, you drive the ship and we sort of sit behind you when it comes to some of the decision making. But oftentimes when folks come to us without an advisor, we almost always lead with, hey, you have this asset you're considering putting in the trust. What do you need liquidity for? What scenarios do you need cash for? And then it almost always ends up with, guess what? Don't put 100% of what you think you want to sell into the trust. Maybe it's 50%, maybe it's 80%, right? We can't tell somebody exactly what number is perfect for them, but you as their advisor can, right? You can go through their financial plan. You can come up with a number that says, hey, I know that you've got, Timmy wants to go to college in 5 years, and, so-and-so wants to build a new house. And so you need X dollars of liquidity from this. As such, put 60% of this piece of property into a trust and sell it, defer the taxes, and then that other 40%, yeah, you're going to pay taxes, but have needs for that money. So, that's one thing we always try to talk to people about when they go through that process. If no other questions, we'll get to sort of the major headline of this for advisors. So ultimately, what does this mean dollar-wise for you, right? Assuming for a minute that you take a 1% fee on all assets managed. This is just an assumption. We could run these numbers for you specifically depending on what sort of fees you take, what you can expect. Just by setting up the trust and helping work with them, or helping them defer that upfront tax piece, that additional $700,000 in the trust growing over time gives you 3x the fees as the advisor over the life of the trust. That's a huge number, right? The client wins, right? Because they make way more money and they have more assets working for them in the market. But you as the advisor also have a base that you get to take 1% on every single year that is consistently growing and started off with more than it did to begin with. So, you get to put the client's needs first, right? And that's sort of every view that we take on every client we work with. It's always the client's needs first, but you can still win, right? Like it's still a win. It's a win-win scenario for them already. And now it gets even further down the line. So all in all, that's the big value driver. Now, obviously these assumptions change and the numbers change based on how much fees you collect, if you manage assets, all the good things that go into it. But if you do, this is where the big value equation is for you. So when we talk to advisors, we try not to use the word no-brainer too frequently because there's obviously always scenarios and things that can impact the decision making. But when you see the numbers for clients, when you see the numbers for advisors, all in all, it seems like it should make sense. My favorite slide of the whole deck, because it's probably the most simple. We talk about win-win scenarios in this world, and really so far through our analysis and through the clients and advisors we've worked with, it's truly sort of a win-win-win scenario, right? The person who wins the most is the client. The client gets to pay less taxes, they have more money over their life, more money to leave for their kids, big win for them. The second winner is really the charity, right? The charity came in here and expected nothing, and they got a large lump sum when the trust ended. And that's to go and benefit any variety of causes that, the person who set up the trust deems. And then the last piece is the advisor, right? You also win. You helped your client, you helped them, do better in their life and helped them achieve some of their goals, but you also made more money. So, there's really no loser in this equation, assuming that trust performs and the assets go the way you want. So that's, at the end of the day, right? Like this is the whole point of today's sort of conversation. We're going to obviously go a little bit deeper into some of our tools. We're going to talk a little bit about our services and how we help. But the main point and the thing that you should walk away with from this today is that by using these tools, specifically CRTs, to help your clients, they can win, the charity can win, and you can win. So,
Joe, do you know if it can be their own charity? If they're the founder of a charity?
Oh yeah. So as long as it qualifies as a 501c3, it can be any charity that they deem, and they can change it over time. This is one of the few things with these trusts that have some flexibility. So sometimes folks choose, American Red Cross, great. You want to benefit American Red Cross. There's nothing wrong with that. Some people set up their own donor advised fund and use that as the tool. Other people set up their own private foundation, right? We have had plenty of high net worth clients that come to us and expect to leave $10 to $50 million to charity at the end. And almost always the answer goes to, well, I guess it's time to set up a private foundation, right? And that's fine too. We leave it up to the client, and you can advise the client any way that you'd like, but all those solutions are viable. We'll do another pause. Any questions, anything specific before we get into sort of how we help, what we do, all the aspects that come with it. So we alluded to this a little bit at the beginning, and I'll walk through these sort of individually. The first and foremost, one of the things that we spend the most time on, and we've spent the most effort on as a team holistically, is creating the tools and the education needed to help clients understand how these tools work. They're not simple, right? They're simple to us because we spend our entire lives working on them. Even as advisors, right? You spend some time working with them, but they're somewhat esoteric. And if you talk to a client about it, more likely than not, they've never heard of it. And if they have, they don't understand how it works. So we've really gone, the length on creating education that's consumable, right? Whether it be case studies for individual client circumstances, crypto investors, startup employees, people that own real estate, whatever it is, right? We've created examples for your clients to have access to, so they can see real life scenarios that apply to them. Also, in-depth explanations around how the charitable remainder trust works without all the legal jargon, without as much of the accounting jargon, right? Like, we're just trying to make it and distill it down to make it easy to understand. I would challenge you that if you go Google the internet and look around for charitable remainder trust, if you can find a website or a provider that has easier to consume content than us, let us know, because we have yet to find them. We've tried to make it as simple as we can for folks. Outside of that, right, that's just sort of the first leg of the stool. The right way to think about us when it comes to this solution and for charitable remainder trust is we're an end-to-end provider, right? We're a one-stop shop. You don't have to go and call an estate lawyer or a tax lawyer. You don't have to go find the trust company. You don't have to go find the bank or deal with all the custodians. We do all of that. So, the first leg is educating people, right? Letting them understand how these tools work. But once someone's decided that they think they're interested and they want to, go down the path of learning more about the trust, then we step into things like our calculators and our guided planning tools, right? Like, how do you calculate the ROI of a charitable remainder trust, right? What's the real benefit? How does it apply to me, my situation, right? And you can custom fit it for every walk of life, age, state. We'll even show you our calculator here in a moment, so you can get a first view at exactly just how we work with clients on it and how you can too. But once a client's decided that they want to do this and they're like, okay, I love the CRUT. The CRUT is my tool of choice. Let's do it, right? We've built the technology and the services, right, that we can get you the trust faster than any lawyer and quicker and easier, right? You can work with a lawyer if you like, if they have an estate lawyer, a tax lawyer, someone they like to work with, someone you like to work with, for sure. You can get them to trust. But we have a no cost, no hassle solution, in that we've worked with various external lawyers and technology providers. So we've built a system in-house that can give the trust to the client with a few minor inputs and a few minor questions. So we make it very simple. And then on the back end, right, once the trust is set up, right, there's so many steps here that I'm sort of skipping, because if we talked about every step, you guys would fall asleep. But all the things that happen in between that we do in the back end, we also do all the administration, all the tax filings. So we take not only the upfront piece where we help them understand it, we don't just set up the trust, we also set up their custodial accounts with you so that you can trade in them. We do all the filings, we do all the administration. Again, it's one simple stop to make it all work. So that's how you should really be thinking about us when it comes to working with these trusts is, hey, we work with Valor, Valor takes care of it all for us. Monty, I don't know if you have anything else to add to that point.
No, I think it's ultimately right. Like, we're here to be a partner for advisors like yourself, and we're here, right? It's ultimately, and the reason you guys are here is that these things are impactful to your clients and want to learn more. But it's also, the stuff is complicated, right? And this is part of the challenges historically. Unless you have a family office or access to those types of resources, it's been hard to leverage these resources or get that quality of services. And kind of that's the role we're trying to fulfill, is how do you enable your clients to get access to these best in class resources to, reduce their taxes and more effectively build their wealth to better set up them and their family's financial future. And that's kind of, we're also always, we're learning from every advisor we work with. So we're always happy to take feedback and figure out how we can better partner and work with you.
Yeah. For sure. I'll come back to the last page of this presentation here in a minute, but I'm going to quickly flip over to our calculator real fast. I want you all to get sort of a view of this. This is, and I'll go back and refresh, but if you, I was just doing some calculations before you guys got on. You know, if you go to our website, right, and you look at, we've got a calculator that we've built, custom in-house, one of the only in the market that can help calculate and tell you what is the true return on investment for a charitable remainder trust, right? Because that's the thing that clients most care about. This is a tool you can access. This is a tool you can walk your clients through. This is a tool that your clients can walk through on their own. It's open to you all. And you're also seeing sort of version 1 of this. We're going to be updating it in the next couple of days so that it's going to completely new look, completely new feel. We'll actually send you all the link once it's done, so you guys can take a new look at the fresh work. But let's just run through a scenario, and you can already see the numbers here. So I'm sort of giving away the outcome. But let's say you have a client that lives in California. They're 45, right? You can go in. Let's say for a minute their cost basis is 0, so they got the asset. Early startup gains. It's great. They plan to sell for $1 million. It's a great outcome for them. It's a big one. We assume in these calculators that they're going to be taxed at long-term gains, but you can toggle between long-term and short-term. And then this is a question on how much of their assets would they like distributed each year, right? Obviously, we haven't gone into the different types of charitable remainder trusts, NIM CRT, standard CRT, but all in all, we're setting sort of an upfront distribution schedule, and then we're letting them toggle and play with and calculate the ROI as they see fit. So as you click next, right, these numbers will update. It should be the exact same numbers. Your client has access to and can enter their email address here to get a custom report directly to their inbox. It'll be with their numbers. It'll be with you know, all the outcomes and all the explanations they could need to talk about charitable remainder trust. And this is something you can give your client. You can even position it that it's a report that you're getting for them, right? Hey, let me go run through your numbers real fast. I'll send you a report that's, you know, just for you, right? It's your service. You're helping with it. I'm going to click just my results just for this. In here, right, this is where the rubber really meets the road. You can toggle so many different things here, and I'm not going to go through all of them, but you can toggle between different types of trusts, lifetime, term, long as possible, which, you know, NIM CRT, standard CRT. So which type of distribution methodology do you want? And then even then, once you've done that, you can go into withdrawals, and you can actually customize how much money do you think you want to pull out each year, right? People have different needs. You know, the Johnson family sets up a trust and they want to pull out $100,000 in year 2, right? So you save this. It updates to $100,000. The ROI will update accordingly. And then you go back if you want to see the ROI. Guess what? The ROI has gone up a little bit, right? We're assuming an apples to apples comparison of using a trust versus not. So this tool is really valuable, right? A lot of times when we do this with our clients and with advisors and clients, the first thing they see is this number, and they're like, okay, why would I not do this, right? It's like, well, let's run through some you know, sensitivity analysis. Let's run some scenarios that you think might be helpful. And so you can really get in here and toggle different things, right? You can play with growth rate assumptions, you know, you can play with how much dividends do they expect to have. So we've really thought of everything. And also, again, you're seeing our version 1 of this calculator. Version 2.0 is coming out here very soon, and it'll be even easier to sort of put these inputs in and run through the math. So this is just one of many tools that we've created. We've got tools like this for other charitable trusts. We've got tools like this for other estate planning trusts. This is part of what we do and part of our mission, which is not only help people understand how these trusts work, but at the same time, what is the math, right? How much can they truly make with it? So I would highly recommend, and we'll follow up with links to this to all the folks who attended, just to like highlight where this is on our website. We recommend trying it out, right? You know, one of the biggest takeaways from this conversation is, and again, this isn't really more of a sales pitch, it's just an opportunity for you. If you have a client scenario that you want to run through, let us know. We'll hop on a call 1v1 with you. We'll do this live. We'll talk about it. We'll toggle the assumptions. We'll see what it looks like. You for yourself can see, like, does this make sense for a client? And if it does, great. Bring it up to them. If it doesn't, then it doesn't always for every scenario, right? You could go back and we could run this scenario a couple of times, and their cost basis could be 800,000 and their sale is $1 million. It might say, hey, guess what? It doesn't make sense because of how much tax you're deferring based how much assets you're locking up in the trust. So again, that's what we're here for. That's our role. And that's sort of what we help with. So that's all. Just wanted to make sure that I gave you guys a chance to see this tool and got to take a look at it. Hopefully it's interesting to you. Any other questions? I'll pause there for a second before I go into sort of final closing notes here in a minute, but happy to answer as many questions as folks have.
And one thing to note is after the report that Joe mentioned there, we'll send the report over after this meeting, just included so you can see what that looks like. It's something we found advisors find really helpful to walk through with their clients.
All right, if just checking Darren's message to make sure I didn't miss a question here. Just as sort of some final notes, we're doing another one of these next Thursday. You asked a great question. How do you sell this? How do you pitch it? How do you position it with clients? We're going to really dive deeper on this and talk a little bit more about how do you do this, and specifically use real life case studies to sort of highlight it, right? Client has real estate, client has public stock. How do you position it? How do you make sure they understand it? You know, how do you compare it potentially to other tools, right? How do you think about the discussion that comes into play when they say, hey, we have other solutions. How should I think about this? So, you know, we'll talk through some rebuttals, all the good things that go with it. And then, you know, talk a little bit more about how, you know, we can work deeper with advisors, all various aspects of the things that we provide. So, you know, appreciate you all for joining and appreciate you for being a part of it. And hopefully you found it informative. Next week, we'll go even deeper and, you know, we'll continue to add content and have more of these webinar series from there. So thank you all for coming. Thanks for taking the time out of the day.